welcome to the Canadian Real Estate Channel. I'm the Godfather, Alfonso Cuadra, and we're doing these lessons from the Godfather. And today we want to kind of piggyback on the last video when we're talking about net operating income. And I mentioned that we use cap rate, and cap rates are used a lot in real estate.
Purpose powerful enough will make you unstoppable.
When we talk about cap rates, this is a industry jargon. This is an industry formula. Who's gonna talk about cap rates? Well, your realtor may talk about cap rates, your lender, your lawyer, people in the industry. Now, if you're buying a single family home or a duplex or a triplex, well, you probably are not going to hear cap rates. Cap rates really become important when we're talking about multifamilies. I would say around 4 units, 4, 5, 6 and up. This is where people start talking about cap rates, and the reason is because it's hard to find comparables. For example, for single family homes, you're going to see that the way that these single family homes are evaluated, they're based on comparables, right? So you got to go to the comps. You got to go to who sold in your neighborhood that's similar to your property, and you find comparables. Shortly after the Second World War, they came up with this formula, capitalization rates. And the reason they came up with this formula is because shortly after the Second World War, you started to see a lot of different properties that were mixed use. For example, you would have industrial with multifamily or commercial. And so they needed a formula to determine the value of the asset. Now, people get confused all the time. Cap rates, who determines the cap rates? This is a market, right? They're not determined by anybody. It's what are people willing to accept as a return? So, for example, in a higher density area, in a major market that's really high density, that means you have more competition and people are willing to accept less as a return. Lower cap rate. In a secondary or tertiary market where you don't have as much competition, where for the most part people are investing for cash flow, you'll see that you'll find properties that are trading at a higher cap rate. So density really impacts the value of properties because you have more competition. And so if you have more competition, that means people are buying these properties with a lower return. And so that's what it is. Net operating income determines the cap rate, the performance of the property. Now, you can go to CMHC, you can Google cap rates in your city, and you'll see that there's a lot of entities that publish the going cap rates in the market, but they don't set the cap rates. They're not set by anybody. They're set by the market. If people are, the competition is less and people need a higher return in order to move forward with that asset, you'll start to see that cap rates will start to rise. For example, interest rates have an impact on cap rates. Higher interest rates means that people are looking for more cash flow, which means that they'll need properties that have higher cap rates in order to service more of the debt. And so it's natural in the next 10 to 12 months, as interest rates start to rise, you'll see that cap rates will also start to rise. But these are markets, and it's not a very specific, nothing's written in stone. It's set by the market. It's set by the investors. and what are they willing to accept as a return. And so more competition, that means that it's competitive. People are willing to accept less as a return. It drives the cap rates down. So let's talk about the cap rates. So the cap rates derive from the net operating income. So you want your annual net operating income, and you want to divide it by the cap rate. Again, you can go on Google, figure out what the cap rates. Now, once you've been doing this for a while, you'll start to notice that, Toronto's cap rate is, right now things are trading at around 3.5%, or let's say you go down to Hamilton, cap rates are hovering around 4%, or Ottawa, the cap rates are hovering around 4%. And so it just gives you an idea of how they came up with the purchase price, or the asking price in this case. So you have an annual net operating income divided by your cap rate gives you your asset value. Very similar. If you take the annual net operating income and you divide it by your asset value, you get your cap rate. Okay? Very simple. You can take any net operating income. You can work with it. Get your handy dandy calculator. Let's say it's $40,000 a year in annual cap rate, an annual net operating income, and you divide it by, let's say, a 5% cap rate. That means the value of this asset is $800,000. Okay, so I love this stuff. By the way, I failed math in school, right? So you don't have to be a math wizard to figure this out. Okay, you just got to do it a few times, get comfortable with it, and it's going to be easy peasy for you. So we have a building, a 6-unit building with an annual net operating income of $45,000 a year. This particular building just happens to be sitting in a market where the cap rate is 5%. So take out your calculators. I want you guys to do it right now. Do it with me. Take out your calculators, and what you're going to see, you're going to take 45,000 and you want to divide it by 5%. And what you're going to see is 900,000, right? So that's the value of this asset. 45,000 divided by a 5% cap rate. Now let's just say that you brought this asset, this same asset, and you brought it to an area, a market where the cap rates were lower. For example, let's say we went to a market where it was 3.5%. That means that this particular market is, higher density, more people, more competition. Even though the performance of this asset is the same, but the location of the asset actually impacts the value of the property. So this same property that it was worth $900,000 in a different market, now we bring it into a market where the cap rates are, properties are trading at 3.5%. All of a sudden, 45,000 divided by 3.5, you'll see that the value of this asset is 1.2 million and change. And so cap rates can be used to analyze deals. Cap rates can be used to figure out what the value of my property is going to be once I've improved the performance of the property. So if the average asset is trading at 4 to 5%, if I increase the net operating income by, let's say, $30,000, then you can see what the value of the property would be, what the new value of the property would be. So use cap rates, have fun, don't be scared of the math. I failed math in high school. Only if my math teacher could see me now. And so cap rates, especially when we're talking about multifamily and apartment buildings, they're very important. Don't be scared. And if you want more information on cap rates or any of this, make sure to reach out to me. This is the Canadian Real Estate Channel. I'm the Godfather, and we'll see you next time.